Hello traders, Igor here, MrTOPTICK.com. Welcome back to the channel. If this is your first time tuning in, consider subscribing to the channel, liking this video, and sharing it with someone you think could learn something from this video. Today I want to talk about a trade we have going in MPC. This is a trade that we put out on November 1st. MPC was trading at about $119. We were looking for a move higher to about $130 level. We structured this trade as a broken wing call butterfly, which was made of two spreads: 120, 130 call debit spread, which is a 10-point wide call debit spread, and a 130, 135 call credit spread, which is a 5-point wide call credit spread. This trade was going for about $2.70 debit at the time. This was the risk profile. So as you can see, we have a 10-point wide debit spread and a 5-point wide credit spread. This trade was filled for $2.60. So now we are here on November 22nd, and I want to talk about a couple of possible either adjustments or managements that could be applied to this trade in order to effectively remove risk and position yourself in a way that if the rally continues, there is a way for you to gain a little more upside. And the reason why we are looking for a rally in this underlying is we noticed today that there's some bullish activity. This is a scanner that I use, black box stocks. As we can see, there are December 23rd, $124 calls being bought on the ask. These are sweeps, size of about $100 to $150,000. So this is not mom and pop loading the boat. I think that there's more upside in this trade. So here's where this trade is currently. This is a one lot, right? And depending on the size of the trade, different techniques could be applied. So first I want to look at a one lot, and then I want to compare or look at a potential adjustment for a trade that is made of more than one contract. So this here is a one contract, right? This is a 120, 130, 135 call butterfly for $2.60 debit. It is currently showing a profit of about 46%. So one way to potentially make an adjustment, my goal would be to pull the $260 investment out of this trade. One way I could potentially adjust this trade is to roll the $120 call that I am long, so I would be selling to close, and buying to open the $125 call. As you can see here, this would equalize this butterfly, meaning that the width of the spreads would be now equal. Before this adjustment, I have a 10-point wide call debit spread and a 5-point wide call credit spread. Rolling the 120 up to 125 will make it a $5 wide call debit spread and a 5-point wide call credit spread. If I made this adjustment, it is currently going for $3 credit, which means that I would be returning the $260 debit that I paid to put this trade on, and I would be left with about a $40 net credit, meaning that regardless of what happens in this trade, regardless of where the underlying is going to settle over the next 24 days, I cannot lose money in this trade. Worst case, if MPC is below 125, I get to keep the $40 credit, or if the underlying is above the 135 level, I get to keep the $40 credit. The best case scenario is that we're somewhere between 125 and 135. The absolute best case scenario is if MPC pins 130 on the dot, meaning my 125, 130 call debit spread will be worth $5 or $500 for that one contract plus the $40 credit. So this trade has a max potential reward at 130 at expiration of around $540. And now we're going to look at the same exact trade, but instead of one contract, we're looking at a 5 contract trade. Same exact premise. $120 long call, 2 short calls in the center. at 130 strike and the long 135, except this trade is not 1, 2, 1. This is a 5, 10, 5. So we're long 5 contracts at 120. We're short 10 contracts at 130. And we're long 5 contracts at 135. The debit for this trade is $260 per 1 contract. So 5 contracts puts us at risk of $1,300, meaning that if at expiration MPC is below 120, this trade has a max potential risk of $1,300. So now with 24 days until expiration, we are anticipating more upside. However, we do need to think about what happens if this stock starts to head lower. I mean, this green dot here shows where we put this trade on. So it's just been kind of range bound to slightly higher, came down to test the 21 EMA yesterday. It is pushing to new high today. Again, the goal here is to pull as much, maybe all of the risk out of this trade and potentially leave ourselves in a position to make a little more profit if, in fact, the stock is going to move higher. So one way we just talked about we can possibly adjust this trade is to move the 120 strike up to 125. So we'll be closing the long 120 call. So we're selling the 5 calls at 120 and buying 5 calls at 125 strike, which is a decent adjustment. What I like to do with trades that have more than 1 contract gives me a little more flexibility, and I could make incremental adjustments. The easiest and my favorite way to adjust these kind of trades would be to look at my net risk, right? I'm risking $1,300 here. So if I was to go and say, all right, I can partially close this trade to take out $1,300 out of this trade. So I can go and look at what is this trade currently going for. And this trade is currently going for about $3.88 or $388 per 1 contract. So I can go and I say, all right, I have $1,300 worth of risk on the table. If I was to close out this trade for $388, how many contracts do I need to close in order for me to pull the $1,300 out of this trade? So I divide $1,300 by $388, which is where this butterfly is trading per contract, and I get a total of 3.35. So obviously we can't close 3.35 contracts. It's either 3 contracts or 4 contracts. Let's take a look at what this trade looks like if we were to close 4 of the 5 contracts. So I would be selling to close 4 of the $120 calls. I would be buying to close 8 of 10 of the short $130 calls, and I'd be selling to close 4 of 5 of the $135 calls. As we can see, this is what this trade would look like after making this adjustment. I would have no risk. Let's go back and have a look at the numbers. So if I was to sell 4 of these butterflies at $388 each, I would be pulling $1,552 before any fees and commissions out of this trade. So this would cover my original investment of $1,300 and leave me with a net credit of $244. This means that I would only have 1 butterfly left with more upside potential. And if MPC is at expiration below 120, I stand to make $240. If MPC is above 135 at expiration, I stand to make the difference between the widths of these 2 spreads, which is 5 points or $500 per 1 contract. I have 1 contract here, so that's $500 potential plus the let's call it $250 net credit. So I could possibly make close to $750 if MPC is above $135. Now the bonus here comes If we pin 130, I have a 10-point wide call spread, which will be worth $10 or $1,000 plus $250 credit. So at a pin at 130 at expiration, this trade could potentially make upwards of $1,250 or so. In any case, whether it's one contract or 5 contracts, taking risk out of any trade makes it a lot easier to hold, because remember, we can always add risk back on. And one of the reasons why I am considering doing this is because there are 24 days left in this trade. And as you know, butterflies are short gamma trades. And as the time starts to run down on the clock, this trade is going to become more and more sensitive to price change, which means that one day, 2 standard deviation move can take this trade from being a nice winner to a pretty nasty loser. Remember, you always have to take care of the risk first, and the profits will always take care of themselves.